Welcome back, everyone. Today we are covering Section 7, Portfolio Management. Once again, we're not your advisors. We're not here to give you specific investment recommendation or advice. We are here to give you education. Any specific company that we do talk about today is to be taken as illustrative and educational purposes only. Here's a great quote by Peter Lynch. It's sarcastic, but it's so true. There seems to be an unwritten rule in Wall Street. If you don't understand it, then put your life savings into it. Here's what we're teaching in this section. We're going to show you how to create a portfolio and the risk and position size. In this part of the section, we're going to teach you how to take the appropriate amount of risk for each investment you put money into. We're going to teach you how to avoid putting your life savings into something you don't understand. We're going to teach you how to avoid putting your life savings into something even if you do understand it. We're going to teach you risk and position size. And then once you've built that portfolio, we're going to teach you how to manage the portfolio. In section 1 of this course, you've learned some of the basics when it comes to investing, such as risk tolerance, time horizon, and investment objectives. In section 2, you learned about the many different types of investment categories, such as common stock versus preferred stock, growth versus income stocks, small caps, mid caps, large caps, as well as the industry groups in which all of these companies fall into. Section 3, you learn the importance of risk management by using strategies such as asset allocation and diversification. And then in 4, you learn what type of brokerage firm to work with, which account type to open based on your needs, and what to look at on a stock screen and how to place a trade. Section 5 was awesome. Here you learned some extremely valuable information on what to look for in a solid business, such as their profit margins, their key growth rates, their debt, cash flow, company news, etc. In Section 6, you learn how to use short-term indicators to spot trends and to help time your entry and exit points. In this section, we're going to put all this together and start creating your portfolio. As you begin to create your portfolio, remember what you learned in section 1, risk tolerance, time horizon, and investment objective. Let's start with risk tolerance. Everyone has a different tolerance for risk. Some of you may want to put 100% of your money into stocks for the long term, and you're okay with the day-to-day fluctuations. Some of you may be looking to put only, say, 20% into stocks, and that's to supplement the lower yielding but safer investments you already own. Identify how much risk you're willing to take, and also think about how much time you have to make up any potential losses. This leads to the next point, which is time horizon. If you're a younger investor with several years to go before you need that money you're investing, you may be able to take on more risk. If your primary need for the money in which you're investing is a shorter time frame, you might want to take on much less risk. And this leads to investment objectives. Is your investment objective long-term growth? Is it current income? Or might it be a combination of both? Again, if you're a younger investor, you may be okay with a portfolio designed entirely for long-term growth. But if you're retiring next year, you may need to look at investments that provide income in lieu of long-term growth, as well as safer vehicles for capital preservation. And you need to be able to answer these questions and identify your risk tolerance, your time horizon, and investment objectives before investing any money. Next, do you understand what you're investing in? If you don't understand it, don't invest in it. As Peter Lynch famously said, again, it was sarcastic, an unwritten rule in Wall Street is if you don't understand it, then you put your life savings into it. He's absolutely right about that. Just look at the insane amount of investors flocking to cryptocurrency right now. Do any of these investors really know what crypto is, how it works, what the risks are, who or what is their competition, what is the intrinsic value? Probably not. Don't make investing any harder than it has to be. If you're investing in something you don't understand, you're making it harder for yourself and you will inevitably lose a lot of money. Keep it simple and invest in what you know or what you are capable of knowing, as Warren Buffett and Charlie Munger once said. Create a list of industries where you have a good amount of knowledge. This should include the industry in which you work, as well as industries who make the products and or services that you often spend your money on. If you understand what you are investing in, it's going to be much easier and it's also going to be more fun. If you don't know what you're investing in, how will you know what the current state of the business is? This is gambling. This isn't investing. Here's some ideas to keep in mind when searching for industries and companies within those industries in which you may invest. Think about where you shop. This is the retail sector. Is there a specific brand that you prefer? How about technology? Is there a tech company whose product makes your life easier? Healthcare has been a big industry for quite some time. Has a company within the healthcare industry given you a better quality of life? How about entertainment? You spend money at the same hotel chain, movie theater, resort, etc. Couple more ideas? Think about the automotive sector. Do you find yourself loyal to a specific car manufacturer? Airlines. If you travel a lot for work or for leisure, do you find yourself loyal to a specific airline when traveling? Another idea is socially conscious investors. Are there any companies that you follow closely because you share a similar belief system? And lastly, employment. Do you have a deeper knowledge of the industry in which you work? Once you've identified the industry groups and companies within those groups that interest you, now you can begin to create your watch list. A watch list is a group of companies that you'll be keeping a close eye on because these are the stocks you want to own when the time is right. Once you find the companies that interest you, there's still some work to do before you decide if it's a worthwhile investment. As you create the watch list, make sure it contains companies that include the investment categories that you'll learn in Section 2. You want to include growth stock and income stock, and you don't want to put all these into large cap big names that you're familiar with. It's a very common mistake. You want to make sure you include small company stocks, mid-sized company stocks, and also the large caps. Why? Because you need to diversify. That's why. Diversification is another important thing to consider, especially if you're a beginner. Go back to Section 3 if you need a refresher on this topic. If you're diversified and you make a mistake while doing your analysis, then you won't get hurt too bad and you're going to live to invest another day. A mistake that we see new investors make all too often is that they try to hit home runs. You'll learn how to invest properly by utilizing the information we teach, but as you begin, you need to take it slowly as you hone your investment skills. Practice makes perfect, and as you get going, you'll become better and better. You'll learn from your mistakes, and you'll become more successful the more you do this. Warren Buffett's pretty vocal about how it's easier knowing everything about just a few companies instead of knowing everything about a lot of companies. And it makes sense, and because of this, he allocates most of his money into just a few companies. However, we're not Warren Buffett, not yet. You can't afford, I can't afford, to put 20% or more into just one position. We need to stay safe and diversify. Now that you have your watch list, you need to pay attention to just those companies. You don't want to buy a stock just because you like the company. The company has to be a fundamentally sound business, and you have to buy the stock only when it represents a bargain price. Do the companies on your watch list possess the criteria that you learn in Section 5? Are their earnings growing, and are they growing consistently? Is cash flow growing and improving each year? Is the current PE lower now than its historical levels? If so, it could be trading at a discount or a bargain price. But if the current PE is higher than historical levels, it might be overvalued. And this is something you need to identify. You also need to make sure the company has a manageable level of debt. Can they pay off the debt within 5 years of cash assets? If not, there could be a problem down the road. Does the company have higher net profit margins compared to their peers? If so, they may have a competitive advantage over their competition, or as Warren Buffett calls it, they have a moat. We also want to make sure we see return on equity, return on assets, and return on invested capital earning 10% or better each year, and ideally higher than their peers. Are sales growing each year? We want to see this for obvious reasons. Check out the news on the company. Do any red flags stand out, or is it mostly positive? If the companies on your watch list meet these criteria, great. You may have found some companies to allocate some of your capital into. But if not, you need to wait until it does pass this criteria. Keep in mind that you need to be very patient. You'll make money consistently when investing in companies that meet this criteria. However, if you're impatient and you rush your capital into a business that only meets some but not all of it, you're putting your capital at risk. Only invest when it meets the previous checklist items, as well as what you learn in the value investing and options trading course. Let's assume for now that the companies on your watch list do meet all of these criteria, and you have the green light to go ahead and buy some shares. There's still one more thing to do to really put the odds of a successful investment in your favor, and that is to use the technical analysis indicators. In section 6, we taught you how to identify trends, how to use the 5 indicators along with the arrows, as well as how to use trend lines to help identify buying opportunities. Many times you're going to find a great fundamentally sound business which is trading at a favorable price because the company's out of favor, the sector's out of favor, or the market as a whole is out of favor. Buying a great company at a discount is how you create long-term wealth, but if a company's out of favor, we don't want to buy it if it is still in an obvious downtrend. We don't want to catch a falling knife, and that's what we call a discounted stock that keeps falling. We want to step in and buy shares of that great discounted business when the selling is ended and it's starting to trend upward. How do we do that? We do that by using the technical analysis indicators. A downtrend is ended once we see higher highs and higher lows. We can also identify that downtrend is ended when most of the 5 indicators get green arrows at roughly the same time. We can also use the trend lines to confirm the above, and we want to see that a stock has either bounced off of support or broken through resistance. Once you get that confirmation, you can buy the stock with absolute confidence. You know it's a great company, you know it's at a discount, and the selling has subsided and now starting to trend upward. If you buy a stock that meets a fundamental analysis and technical analysis criteria, you will have a process that will lead you to a path of consistent winners and a path towards wealth creation. You're going to create wealth by investing in great, solid, fundamentally sound businesses that are acquired at a discount. You're going to hold on to those companies as long as it makes sense. This is our main strategy. This is long-term wealth creation. In the value investing and options trading course, we go into detail on when it makes sense to sell. But what if you do if those companies on our watch list are not yet at a discount or don't meet the criteria based on the fundamental analysis? There's 2 things. We wait for a discount. Since it's on our watch list, we're going to be keeping an eye on it regularly, so be patient. And then second, we use short-term trades. Short-term trades will allow us to profit in any market direction. There's trades designed to profit if the market's flat, there's trades designed to profit if the market's going down, and of course there's trades to profit if the market's going up. We place these trades using the technical indicators taught in section 6. Short-term trades, based on the trades that we use, are 30 to 45 days. And in the next course, we're going to teach you some other more advanced trades. And some of these are longer term, up to 2 years. Here's what we've done so far. You've identified your risk tolerance, time horizon, and investment objectives. You've created a list of companies that you understand and you want to own. And for diversification purposes, this list consists of companies in several different investment categories. You've identified companies that possess all the criteria that makes a business strong, fundamentally sound for the long term, and you've used the short-term indicators to give you clear entry signals. You've also learned to use short-term trades to supplement your long-term investing, and now you're ready to place some trades. We go in depth again on risk and position size in the next course, the value investing and options trading course, but for now we're going to go over just a few of the more important items here. Every investment carries some level of risk. Even money market accounts at the bank have risk. Asset allocation and diversification are 2 ways to reduce that. Another way to reduce risk is through proper position sizing. Position sizing refers to the total amount of your investment portfolio that will be allocated into each position. If you have a portfolio and that's valued at $100,000 and you happen to put 15 grand into XYZ stock, that position size is 15% of your portfolio. There's 2 schools of thought when it comes to how much of your portfolio should go into each investment. First, some investors would rather know everything they can about just a few companies. Therefore, position sizes that are very concentrated, say 20% or more to any one investment, may make sense. Several hedge fund managers apply this school of thought. Warren Buffett, as we already mentioned, he owns several businesses, but 63% of his $90 billion portfolio is allocated into just 4 companies. Here's why they're able to over-concentrate into a smaller number of holdings. They are seasoned investors with an incredible amount of portfolio management experience, and they also have huge teams of highly paid research analysts, as well as billions in the bank. For the rest of the world who have less investment experience, you shouldn't risk such a large percentage of your liquid net worth on any one trade. Position sizing is the first and probably most important way investors can protect themselves from what's known as the catastrophic loss. This happens when you get a little too excited about a particular investment. Instead of thinking of a worst case scenario and what could go wrong with that stock, you start to think about the potential exciting returns you can make. So you make a huge bet, you swing for the fence instead of properly allocating your position based on your experience and risk tolerance. Let's say you had $100,000 and you made a huge bet and it cost you, and that $100,000 fell to 60 grand. It's going to take you a very long time to get back to break even. That one loss, which in this example cost you 40% of your portfolio, would have to grow by 66.5% just to get back to break even, $100,000. The S&P 500 index has averaged a rate of return of 8.84% over the last 15 years. That's according to data on Morningstar.com as of October 2018, and I used SPY, that is the S&P 500 ETF. That means it's going to take about 7.5 years just to get back to break even. Divide that by 8.84%, which is the S&P 500 index average annual rate of return over the last 15 years, equals 7.5 years. Since you're trying to recover those losses and get back to break even, that would represent 7.5 years without any capital appreciation. Can you afford 7.5 years of zero growth and zero compounded interest? That leads us to the second school of thought on position sizing. Stay diversified. We don't know everything about every company, nor do we have a staff to do the research for us. Therefore, we need to allocate our positions into smaller percentages of our portfolio. If we have a major loss, we're going to live to see another day. Most great investors will tell you never put more than 3 to 5% of your account into any one position. And when dealing with more volatile investments, position sizes such as 1% or smaller would be more appropriate. Here's an example of a hypothetical $100,000 portfolio. 100 grand, and we're going to put 5% max into any one position. That means in this example, we could put $5,000 into any one investment. So we can have 20 holdings in our portfolio minimum. Doesn't mean we have to rush in and purchase 20 positions right away. We can start out with 1 or 2 companies to invest in if, and only if, you find 1 or 2 that fit the fundamental analysis criteria. You can also allocate some of that into short-term trades on stocks that pass our fundamental analysis criteria, but are not currently at a discounted price. The rest should be in a money market account until you find other opportunities. At any given time, my allocation between the long-term stocks and short-term trades change depending on market conditions. If the market's undervalued or even fairly valued, I'm going to have just about all of my liquid net worth invested in long-term stocks. If the market's overvalued, it's going to be very difficult to find great companies that are at discounted prices. Most great companies will be overvalued in that type of market. Therefore, the types of stocks that I'm looking for are going to be very hard to find. So in that type of situation, we're going to have a larger portion of our portfolio in short-term trades. In a normal market environment, I think a pretty good allocation for a stock portfolio would look something like this. And please note, this is just an illustration. This is not a recommendation, so don't go out there and completely change your portfolio to fit this. This is an illustration. 70% of stocks that fit the fundamental analysis criteria. 20% should be allocated into short-term trades, and then 10% is going to sit in cash while we wait for other opportunities to use that. We have 70% allocated into stocks. This is where your long-term wealth is going to be made, and this is going to be invested for the longer term. 70% of stocks in a $100,000 portfolio means that we have $70,000 to allocate to this portion of the portfolio. At 5% into any position, we can have 14 holdings minimum. Next, we put 20% into short-term trades. That's $20,000 allocated here, and we can have 4 holdings minimum in short-term trades. And then 10% is going to be in cash or a money market. This is a parking spot for our capital until we find something worth investing in. In an overvalued market, it's perfectly fine to have more money than usual sitting in cash. Don't worry if you're not making a return on that money, but think about how those assets are protected against a possible correction. We have 10% in cash. That equals $5,000 per position, so we can have 2 potential holdings when the time is right, minimum. As great as this strategy is, it's not worth anything if you lose all of your capital making dumb, big bets. Once you get better at this, you can increase your position size if you can tolerate the risk. Until then, you need to play it safe and reduce that risk by using proper risk management and proper position sizing. Use proper position sizes of 5% or less into any one investment. Next, we're going to get into managing a portfolio. The main purpose of managing a portfolio is to minimize risk and maximize returns. You minimize the risk by selecting the proper amount of your portfolio that will be allocated into stocks, that's asset allocation. You also minimize the risk by searching for stocks within different industry groups and different sizes of those companies, such as small, mid, and large caps. That's diversification. And lastly, you can also minimize the risk by using proper position sizing into each trade. We maximize our returns by simply paying attention to the holdings in the portfolio and making adjustments as needed. You've learned to watch the companies on your watch list on a regular basis for ideal times to enter into positions once it meets our criteria. But you also need to pay attention to the companies you've already invested in to make sure they maintain the fundamental analysis criteria. Ideally, once you buy a great business, you want to hold on to it forever. That's the perfect situation. But times change, and sometimes these awesome companies become not so awesome companies. There are going to be times when you need to move on from the companies within your portfolio. Managing a position is as simple as reading the news on the company for your long-term holdings and watching the technical analysis indicators for short-term trades. You don't need to do this every day, but you should have alerts set up on your phone, your tablet, or your computer to notify you when an important news event regarding your company occurs. Most websites, such as Yahoo Finance, Seeking Alpha, CNBC, and many others, as well as the phone apps, let you set up these watch lists as well as alert notifications for those companies. Another thing that you should do each and every quarter is to read the quarterly reports on the companies you own. This will give you an in-depth report on everything you need to know about the business, such as new product developments, new hires, the competition, previous quarter financials, and expectations for the upcoming quarter. By reading the quarterly reports and the news alerts, you're going to be well informed on the companies that you own in your portfolio. As you stay informed, here are a couple things to look for. Has the story changed? You bought the stock because it was a great company that you understood, probably had a really good management team, and it passed all the items on our checklist. Has that changed since you bought it? Has the moat been breached since you bought it? You gave it ample time and it hasn't done anything. And another thing to look for is it reached its target price and or it's overvalued. You bought the stock because it passed the criteria that we look for in a solid, fundamentally sound business. The company had a great story behind it, but now we realize the great story is changing to a bad story. You may need to reevaluate whether or not you should hang in there, and a couple things to look for. Did the CEO retire? It was a shareholder-friendly CEO. You like the CEO. Has the CEO become ill and unable to perform his job? Has the CEO stepped down? Has a new CEO stepped in with a different view on how to run the business? Government regulations is a big one also. Are government regulations changing how the company operates? Another big thing to look at is the company facing any major lawsuits? Earnings are no longer growing organically through sales, rather, they're growing by cost cutting or acquisitions. Earnings are deteriorating quarter after quarter. If we bought a company that had a moat, but now that moat's been breached, we may need to bail. A great way to determine if this is happening is if you notice that the net profit margins are declining quarter after quarter. Another way is to look at return on equity, return on assets, and return on capital. If these figures are also declining, that means that competition is taking business away from your company. And once that occurs, the moat has been breached. We've mentioned the need to be patient a few times in this course. When you buy a stock at a discount, it doesn't always go straight up the day that you purchase your shares. Sometimes it may take a while. However, you gave it ample time and the stock just isn't moving the way you thought it would, you should probably move on. Billionaire hedge fund manager and Columbia University professor Joel Greenblatt said he gives it 2 to 3 years. If it is not appreciated by then, he moves that capital into other more promising opportunities. And lastly, and the only way I really like to exit a position is if the stock has reached my target price and kept going to a point where now it's overvalued. An overvalued stock does not stay overvalued forever. It can stay overvalued for quite some time, but eventually it's going to come back down to where it should be valued at. When it becomes overvalued, here's what you should do. Smile, pat yourself on the back, sell some or all of your shares, and then repeat what you did to find that winner. And do it over and over again. Lastly, keep a journal. If you sell your shares because the story changed, the moat was breached, or the stock didn't move after you gave it ample time, then take notes about what happened. Was there something in your analysis that could have predicted those events or prevented you from entering into the position in the first place? Just as important, take notes and journal your winners. If everything went according to plan, the stock soared to and above your target price, and you sold because it was too overvalued, take notes. What did you do right? Journal it. You want to learn from your mistakes and duplicate your successes. Since this is a basics beginner's course, I didn't go into detail on other reasons to sell, most notably when to sell based on valuations. Before you can run, you need to walk, and in this course, we're trying to teach you how to walk. In the next course, the value investing and options trading course, we build on the knowledge you've learned here. You will continue to build on that in sections 1 through 6 as you learn more ways to find and analyze a potential investment. In sections 7, 8, and 9, you're going to learn 13 ways to calculate a company's intrinsic value. We're going to start with some very basic grade school calculations that you can do in your head, and then there's some more advanced options that we throw in there as well. Once you complete those sections, you will have a very good understanding of valuations, and that's going to help you know when to get into a position, and also that's going to help you know when to sell a position. In this section, you've learned how to take everything that you've learned up to this point and begin creating a portfolio. You now know your risk tolerance and time horizon. You've determined your investment objectives. You know how much you'll be allocating into stocks. You know which industries and companies you're going to put in your watch list. You've identified companies worth investing in based on fundamental analysis. You know when to enter into a position based on technical analysis. You know how to take advantage of the companies in your watch list using short-term trades. You know how much money should be allocated in any investment or trade using proper position size. You know how to stay informed and what to look for once you own an investment, and now you know when to sell. Here's your learning activity for this section. Start to build your watch list. You've done a lot of practicing with the 3 companies you've used throughout the course. Now it's time to add to that list. As you've learned in this section, you need to be diversified, and you can't put too much money into any one position. Therefore, you need to add to your watch list. Start adding to your watch list by adding companies that are in industries in which you have an interest or specialized knowledge. Now, I want you to try to get at least 20 companies on that watch list. So that's it for section 7. I look forward to seeing you over in section 8. Take care.